Hello everyone, welcome to chapter 8. Today we're going to discuss chapter 8 account for receivable. We are using a book called Accounting Principle, 9 editions. Publisher is Wagon, Kisot, Kimmel, Tenholm, Warren, Novak, prepared by David Mussel, FCPA and CFCMA. It is the book author, copyright is owned by John Wiley and Sons. Okay, let's look at this chapter. We're gonna learn a few number of learning objectives here. There's four of them. Number one is prepare journal entries for account receivable transactions. Number two, demonstrate how to value accounts receivable and prepare adjusting journal entries for uncollectible accounts. Number three, prepare journal entries for notes receivable and transactions. Number four, demonstrate the presentation analysis and management receivables. Receivable are there's a recognition and valuation as well. In terms of non-receivable, there's recognition and dispositions, and statement presentation and management of receivable, such as presentation, analysis, and accelerating cash receipt from receivable. What's the learning objective number one? Number one, we need to be able to prepare journal entries for account receivable transactions. Okay, what are those things? Okay, let's look at the types of the receivable. Amount due from individual and other companies. For example, account receivable amount owed by customer on account. For example, I'm selling samosa $1,000 to BMO Bank on account. So I'm gonna record my sales $1,000. My account receivable credit $1,000. Expected to be collected within 30 days or so. The receivable, however, supported by formal instruction of credit such as period to 30 days or longer and interest bearing. Okay, let's look at the recognition of the account receivable. Record receivable is recorded when the service is performed and is completed by the customer in a given credit term. Performance obligation is complete. Goods have been transferred to customer and customer is given a credit terms. What are those things? Again, here is July 1, account receivable, Mega Mart. 1,000 sales is 1,000 as credit there. Receivable is debit. Mega Mart is sales is credit here, sales. Okay, so that's to record Mega Mart credit. Assets plus 1,000. Receivable on receivable 1,000. There's no effect in terms of cash flow. In terms of the calculation here, assets, if there's any, return is minus. We're going to look at the journaling. Sales return allowance is $100 debit. Account receivable Mega Mart credit $100 to record credit granted for Mart for return goods on credit memo. So there's a return $100. So you're going to record, here's the record of it. Okay. Number four, the record is going to be here. On the 10th, cash is 1,000 minus 100, or the returns times 98%, which is 882, and sales discount is given 2%. 100 minus 100 times 2%, which is 18. Account receivable will be Mega Mart 1,000 minus 100, which is 900 credit side. This is to record of Mega Mart account receivable. So how you gonna logically here doing it? A plus 882 minus 900, the cash flow is 882, and then minus 18 is here. Okay, so this is number 10. This is how you look at the cash flow side. Subsidiary account receivable ledger used to track individual customer account. Each entry is effectively posted twice to subsidiary ledger. There's a ledger is summary form. The credit card receivable, credit card sales are treated as sales account, unlike debit and bank credit card sales treated as cash sales. June 1 credit card receivable is 400 plus. Excuse me. Credit card receivable debit is 400. Sales credit is 400 to record sales of merchandise on credit card. Sorry, my apology. Interest revenue, if a customer does not pay in full within a specific period, financing charge interest is added to the balance due, recognized as interest revenue, which is August 31st, account receivable skills online, $30, debit, interest revenue credit $30 to record interest on amount due. Okay. Learning objective 2, demonstrate how to value account receivable and prepare adjusting journal entry for amounts. So, some receivable will become uncollectible, not reported as an asset if no future benefits. It has a carrying amount to the collectible amount. Receivables are written down to their collectible amount, but record as bad debt expense. Uncollectible receivable amounts are estimated by each period using the accepted method. The allowance method. There's three features of the allowance method. Amount of uncollectible receivable is estimated and recorded at the end of the period. Adjusting entry is recorded. and actual uncollectible are written off against the allowance when it is determined. The speak account is uncollectible. If an account previously written off is recovered, the original write-off is reversed and the collection is recorded. Allowance for doubtful account is the estimated uncollected amounts recorded as credit in a contract asset account. Allowance for doubtful accounts, okay? Deducted from account receivable in the current assets section of the balance sheet. Carrying amount is the gross account receivable less the allowance for doubtful account. So the logic here, gross account receivable minus allowance for doubtful account equal to carrying amount. So the gross account receivable is 200,000 given to you. The allowance for doubtful is 25,000. The carrying amount will be 175,000. So estimating the allowance is based on the percentage of receivable approach. How are you going to do that? Calculate the percentage of receivable that are estimated to be uncollectible using past experience and credit policy. Example, if you have a tendency of 1% of bad credit, you're going to apply that 1% continuously, okay? And can be applied to total receivable balance or amounts grouped by age, requires an aging schedule, better estimate of carrying amount, and more separate to balance sheet reporting. Also called the balance sheet approach, okay? Estimating the allowance percentage of residual cost is known as well as balance sheet approach. The goal is to estimate the required balance in the allowance for doubtful accounts. How are you going to do that? The logic, the required balance in the allowance for doubtful account, estimated uncollected accounts, in bracket 25,000 here, minus unadjusted credit balance in the allowance for doubtful account, which is 1,000. You got the bad debt expense here, 24,000. And then required balance in the allowance doubtful account, estimated uncollected amount is 25,000 plus unadjusted account. Adjusted debit balance in the allowance doubtful account is 500. So you got equal to bad debt expense, 25,500. In terms of the percentage of net credit sales that are estimated to be uncollectible, it is based again on the past experience of credit reports. This is known as the income statement approach. Okay, this is estimating allowance for percentage sales approach. Okay, this slide is based on percentage sales approach. It's calculating the percentage of net credit sales that are estimated to be uncollectible. Result in better matching of expenses with revenues. Any existing balance of allowance for doubtful is ignored when calculating the amount or adjusting entry. Estimated percent of net credit sales that will be uncollectible times net credit sales equal to bad debt expense. For in this particular case, the estimated is 2%, the net credit is 1.2 million, so the bad debt will be 24,000. Okay, number one, recording estimated uncollectible amount. Estimated uncollectible amount is debit to account, bad debt expense, credit to contract asset account for doubtful account. So how are you going to book it? Book it December 31st, bad debt expense. Debit is 25,500. And then allowance for double credit, 25,500. This is basically to record the estimated of uncollectible amounts. So number two, recording write-off of uncollectible accounts. Amount written off debit to the allowance account. Bad debt expense is not recognized. Expense previously recognized when allowance initially recorded. So how are you going to book that? Match 1. Allowance for doubtful accounts is 4,500 debit. And account receivable of kids online, which is credit 4,500, which is to record the write-off of uncollectible account. When you do have a recovery, number 3, recovery of uncollected accounts, the cash is collected from a customer after the account has been written off. So the reverse write-off, entry to restore customer account. Number 2, record the collection of account receivable in the unusual way. So July 1st here, you get an account receivable kids online, 4,500 debit, allowance for doubtful account, credit 4,500 to reverse the write-off of the kids online. Excuse me. July 1, you get a cash, debit is 4,500, account receivable, credit kids online 4,500 to record collection of the kids online. So the data analytics and receivable management is valuable for predictive analysis, allowing for improved evaluation of customer risk profile, can forecast which customer are likely to pay late, and can predict impact of changes in credit policy and processes. Learning object number 3 is to prepare journal entry for not receivable transactions, and not receivable are credit that may be granted in exchange of promissory notes, such as formal credit instrument, written promise to pay specific amount of money and demand at a definite time. And then the party making the money is the maker. The party to whom the payment is to be made is called the payee. There's the maker is the party making the promise, and the payee is the party to whom the payment is to be made. Okay, that's the logic definition term. Okay. Recognition of note receivable. If the note receivable to settle receivable, you're going to book it May 31st here. Note receivable highly, 10,000 debit. Account receivable highly, 10,000 credit to record acceptance of highly note. If the received cash or credit is to cash, note are valued that are carrying amounts. Similar process to determine bad debt expense and allowance for the account receivable. How are you going to record interest? Formula the calculated interest will be principal amount of note times annual interest rate times in terms of 1 year equal to interest. How are you going to put that? 10,000 times 6% times 4 divided by, this is for 4 months. So you got the interest of $200. So June 30th for the 1 month. Interest result will be $50 debit. Interest revenue will be 10,000 times 6%. And 1,000 is $50 credit. So this is basically to accrue interest on highly not receivable. An annual rate of interest and separate interest receivable account is used to value the note as alerted. Okay? And disposing note receivable and honoring the note receivable. A note is honored when paid is in full and its maturity date. The amount due is principal plus interest. 730 cash is 10,200. Note receivable highly 10,000. Credit. Interest revenue credit 150. Interest receivable credit 150 to record collection of highly note. Okay? Disposing of receivable is that a note is dishonored if not paid in full at maturity. Note is no longer negotiable. Pay still has a valid claim maker. Balance is transferred to account receivable in expected eventual collection. 730 is account receivable highly is 10,200 debit. Note receivable highly credit 10,000. Interest revenue credit is 150. Interest receivable 50. This is to record dishonoring highly note where the collection is expected, because a note is dishonored if not paid in full at maturity. Alright, learning objective number 4 is to demonstrate presentation analysis and management receivable. Each major type of receivable is identified on the balance sheet or in the notes. Generally reported separately in the current non-current section of the balance sheet. It disclosed in the receivable. It is a gross amount of the allowance double account and must also be disclosed either on the balance sheet or in the notes. Okay, and then analysis of the receivable. Management monitor the relation between sales, receivable, and cash. Receivable should increase with sales and should increase with good signal trouble. You make sure the receivable are good and can be collected. Okay, if it is not, it's going to be in trouble. Receivable ratio used to determine the management of receivable is helping or hurting liquidity. That's the key part, okay? Receivable can also be used for factoring. You can go to finance or leasing company to factor your receivable. But the sooner you collect your receivable is the better it is for your liquidity. That's the key part, okay? The key part in receivable is the faster the collection is, the better for you as your company, as the company. All right, let's look at the next slide. Analysis of receivable turnover ratio is measure the number of times or average that receivables are collected in a period. The higher the number, the more liquid the receivable are. Net credit sales divided by average gross account receivable equal to receivable turnover. The higher the number, the more liquid the receivable are. The credit sales is 22,883 divided by 3414 plus 2981. So this is the average one. Okay, that's how you get a turnover. The key part, the higher the number, the lower liquid the receivable are. Excuse me. Collection period is to calculate the average number of days the account receivable are outstanding. Days in year divided by receivable turnover equal to collection period. 365 divided 7.2 equal to 50.7. So in terms of operating cycle, the calculated number of days to complete the operating cycle, it is a purchase of either through collection of cash. The logic will be days of sales in unit plus collection period equal to operating cycle in days. So 43 days plus 35 days equal to 78 days. It is calculate the number of days to complete the operating cycle. That's the logic. Actually, cash from receivable, to shorten the cash to customer cycle, loans secured by receivable, borrow from bank using it as collateral. This is the most common. You can get a loan secured by collateral. Sales or receivable provides immediate of cash and reduce cost of medical collection. This is called factoring. So most in Asia, when I was with investment banking with Nomura and Morgan Grenfell, and we do a lot of factoring here. Sales receivable. Some of them is some companies issue promissory note backed by the receivables. Okay, that's basically what it is. If this chapter is basically the closing of this chapter is the copyright owned by John Wiley 22. All right, thank you for everyone for watching the video. My apology for having a cough. Just having a little bit sore throat today. Thank you everyone. So hopefully see you in the next week or next video. Bye bye.